Hi, I'm Wayne Best. We're here today to talk about the 2023 annual outlook. Now, 2022 was a bumpy and really volatile year when you think about it. Between the war, inflation, interest rate hikes, it created a lot of challenges and, frankly, uncertainty for businesses, our clients, and even consumers. We're here today to talk more about where we see things going in 2023 by identifying 5 key trends about how the year will unfold. I'm joined today with Michael Brown, our Principal U.S. Economist, to walk us through each of those 5 key themes. And Michael, let's just jump into it. What's number 1?
Sure, Wayne. Well, sad news is it's a recession. When we take a look at the momentum of the economy, at least so far through the third and fourth quarter of this year, it looks like we're kind of losing steam with respect to some of those interest rate sensitive sectors, such as housing, commercial real estate, and of course, business investment as well. So it does look like the economy is decelerating, and we're expecting a mild 3-quarter recession, likely beginning the middle to the latter half of the first quarter of next year, probably lasting through the third quarter of next year. But again, hopefully this is going to be one of those mild downturns.
Where do you see the second theme unfolding, or how do you see it unfolding?
Well, I think one of the characteristics about this downturn in particular is this is going to be the first time in a long time where the Federal Reserve is going to keep interest rates unchanged, at least in our view, throughout the entirety of the downturn. Think back to 2007. Think back to 2020 during the pandemic. The Fed cut rates almost to zero and started their program of bond buying. We call it quantitative easing. And essentially what happened is they stimulated the economy through lower rates. Well, the byproduct of that is higher inflation, and that's what the Fed's fighting right now. So we're expecting them to keep rates elevated throughout the pandemic, again, to bring that rate of inflation down. You had mentioned the sky-high prices in 2022. We're hoping that changes next year with these high interest rates. The other dimension of this is Congress. We have a divided Congress going into the next session, starting in January the 3rd, and frankly, the borrowing cost of the federal government has become a factor now, at least in policymakers' decisions. And so we think that there's not likely to be a lot of stimulus that we saw in the last cycle as well.
So we have a mild downturn in 2023. We think it's generally going to be V-shaped, and if we can, maybe a lowercase v. But no stimulus, monetary or fiscal stimulus happening, which is pretty unprecedented when you go back in time. Tell us about trend number 3.
Well, one of the trends that we have been tracking for the last couple of years now has been related to supply chains. And you know better than I do about the global interconnectedness with our colleagues around the world telling us, it's tough to get things out of China. There's continued uncertainty around public policies there. We have challenges with respect to energy feeding into Europe, and that has the potential to create some bottlenecks in the supply chain as well. So the good news is we see supply chain pressures easing, so things are getting a little better. But the bad news is that all those headwinds we face this year, at least in principle, are still there as we march in to 2023. So there are certainly some risks to supply chains on the horizon.
That has been a real challenge that we've had really since the pandemic, exacerbated by the war. And it's something that we're going to have to watch very closely because I do believe that remains a wild card in our forecast as we look into next year. Let's go into number 4.
Well, number 4 really relates to the labor market. And I know you've heard it from our clients, but everybody is talking about throughout most of this year how difficult it was to attract, retain employees. We're paying more for workers. And the expectation is, as we march into a downturn next year, that some of that labor market tightness will start easing. We think that's true, but what we think a lot of folks are missing is on the backside of the recession, the fundamentals behind what is driving the labor market tightness our aging population here in the U.S., the fact that we've not seen a lot of net new migrants come into the U.S., particularly of the working age population. Those headwinds still persist, and we think on the backside of this downturn, we're going to be right back in these tight labor market dynamics. May take a quarter or two, but we think we get there.
You know, it's interesting when you look at the population growth in the United States. Last year, it was at one of the lowest levels we've seen since 1900. So we've been talking about these demographic shifts that have been happening really for years, and it's now all starting to come to a head. And I think that's an important distinction as we think about not only 2023, but really through the balance of this decade.
You know, it's interesting because if you look at those individuals who have left the labor force pre-pandemic to now, 61% of them are over the age of 55. So these are retirees and early retirees. Maybe some of them come back into the workforce, but my bet is they're on the beach in South Carolina enjoying life.
Well, some of them have retired a little bit early, but their spouses have said, no, you got to leave the house and it's time for you to go back to work. And so we've seen upwards of 1.5 million retirees actually rejoin the labor force. Let's hit number 5, big one.
Well, yeah, you're right. Number 5 is really our explanation for why we see that mild V-shaped recovery that you talked about. Really, the fundamental factor that has been creating the headwind, slowing at least the consumer spending side of the economy, has been inflation this year. We're expecting those inflation rates to come down. We use a concept called real disposable income growth. To denerd that, after tax, adjusted for inflation, what are folks bringing home? That has been negative all 4 quarters this year, and we think that by the time we get to the end of 2023, so 4th quarter of next year, we're going to reach what we call the inflation inflection point. It's a term we have coined in the team to describe when inflation starts falling below the rate of wage growth. Consumers have real purchasing power with their pent-up savings post-pandemic, we think helps lift the economy out of the recession next year.
And certainly that would imply that while we'll have a very kind of dour outlook in the first part of the year, we could see things really start to change pretty dramatically in the latter part of 2023. This inflation inflection point, I think, is a very interesting and captures the real essence of the challenges that we have in inflation as well as wage growth right now and the decoupling of those two. And it's something we'll need to watch very closely as we go forward. So mild level of recession, we would see inflation starting to come down in many cases just because we're lapping some of those higher prices from last year. Oil, gasoline, for example, is now negative in terms of inflation. And many of these factors are really starting to play out pretty much along the playbook that we've outlined. You know, of course, we cover this and all of these key trends in 2023 in our latest annual outlook. Please have a read. I think you'll find it quite fascinating. Information to think about how best to run your business as we go forward. And with that, best of success to you and your business. Thanks, Michael, for joining me today, and we look forward to talking to you soon.